Today, my guest is Richard Wilson. Richard is the principal and founder of Family Office Club and Centimillionaires Advisors, LLC. He hosts over 25 live events for family office and has over 1,750 registered investors in his private club. He's also the author of the #1 most popular book ever written on the topic of family office wealth management, called The Single Family Office. And today we're going to talk with Richard about 6 headaches faced by centimillionaires. But first, a quick reminder, if you like the show, we would love to hear from you. Please consider liking, sharing, and subscribing. And like I said, leave a comment because we would love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, and that's Commercial Real Estate Pro Network. With that, I want to welcome my guest. Richard, welcome to CREPN Radio.
Yeah, thank you for having me here, Darren.
Richard, I'm excited to talk with you today. I've been aware of you for a number of years now. And but before we jump into our topic today, if you could take just a minute and share with our listeners a little bit about your background and how you got into the family office market.
Sure. Well, I was doing risk consulting for publicly traded companies, and then moved from that to being a placement agent and working with hedge funds and long-only investment managers. And while doing that, I was reaching out to wealth management firms and institutional investors, and I found neither were a good fit for my hedge fund client. So I discovered there was something called a family office. It was back in 2006, 2007. And I thought to myself, well, I should only be meeting with these family office folks, but I found that very hard to read articles about them, hard to find white papers, hard to watch videos, hard to learn just about anything. And so I just started documenting my journey, and I started meeting only with them, talking to only to them. And it turns out a lot of them don't talk to each other. They don't talk to the press. Some of them are very private. So after just speaking a few times at a few events and sharing what I was learning online, it just kind of took on a life of its own. We bought familyoffices.com a decade ago. I got started 12 years ago at the Family Office Club, and it just kind of speaking invites on top of book publishing deals, et cetera. And just, 12 years later, we have an 18-person team here in the Miami area, and we've done 115 events and put out about a dozen books and 1,800 videos. So I've put out a lot of content in this niche, which was very opaque before.
Oh, that's awesome. And I just want to ask you on the as you were looking and realizing that there was nothing out there that was speaking and that they weren't necessarily speaking to each other, mm-hmm. How did you realize what to talk with them, or what was it that they were? I mean, what did you tap into that they weren't finding or wasn't available, or was it just there was nothing so that anything you put out there was on target?
There was very little, so that was one basis. But also at the beginning, I really thought I could position myself as the hedge fund expert in the family office space, or the hedge fund expert in front of various investors, including family offices. But then I learned that there's a lot of inefficiency in the area of how to raise capital. And that was a nugget I learned early. And then there's a lot of inefficiency in the family office space that isn't at risk of going out of trend. Hedge funds might become a hotter thing. Oil and gas might come in and out of favor, et cetera. But an investor base that is growing, or even just an investor base that's stable, like endowment funds, that's only growing a little bit each year, that's always going to be of interest and high demand, because everyone raising capital wants access to that investor base. And that investor base is always trying to improve their best practices. That made me really decide, above everything else, just focusing on the family office industry. And then really I just took an approach like Gary Vaynerchuk prescribes, of just documenting your journey and just sharing what I was learning. So I would read 5 articles plus go to 3 meetings and say, well, this is what I'm seeing happening on impact investments, or here's what I'm seeing family offices are actually paying in hedge fund fees versus, what the market is trying to make them pay, et cetera.
Interesting. And was the growth rapid, or was it kind of slow at first?
I mean, it was rapid considering I started in 2007, and we did, it was a half year, and we did 170,000. Next year we did 350. Next year we did 700 some, and then next year we were a 7-figure business. So given that it was through the financial downturn, I think it was relatively rapid for those reasons. Yeah, but definitely a lot of hard work. I mean, the first 2-3 years, we really didn't have a solid business model. We had experiments going on having a certification program on hedge funds and later family offices and capital raising. And, I was doing a lot of speaking engagements at other people's events. I wasn't hosting my own events yet. We'd only had an ebook on our website and some advertisers there, and our family office databases.com, investor directories were starting to be sold, but we didn't have a real solid business plan. Now we have, structured divisions and consistent lines of revenue and subscribers, retainers, et cetera. Back then it was kind of, let's see how to survive and become a thought leader in this niche, but survive that process.
Well, you mentioned kind of the growth and stuff, and I'm curious, did you find the speaking events as one of the primary magnets for people finding you, or were they out there clicking online looking for articles, or how was?
Yeah, really good question. So at the beginning, it was really strong digital, but I found that we would sell some advertising, some databases, but working with the client on a consulting basis or a more serious business venture was harder to pull off when we just had these digital assets like a big LinkedIn group and a popular blog and website. But then I found when that combined with, that's why I got invited to speak places. So it fed off of each other. When I combined all the online content I'd created, so I gained a ton of knowledge and a lot of connections and deal flow, but then I'd go speak somewhere, the relationships I would make in the room were where I could do more meaningful business, even though I wouldn't have gotten that speaking engagement if it wasn't for all the online activity. So the online activity was like a conduit to get me a speaking engagement, which got me in front of a room of qualified prospects. And doing that 100 times in 14 countries connected me, with over 1,500 family offices face to face, and taught me a lot and got me better connected, better deal flow. And then my online content got better. And then I got a book deal with Wiley. So it just fed on itself over and over again. And then really it was just the underlying question on how to grow fast and how you scaled it up is really listening to what people were complaining about all the time, or what nobody else was doing in the niche of family offices. And that is why, we have the Family Office Club at the center, but very importantly, we're not a placement agent or investment banker that goes out and find you the 15 investors you need to close a real estate deal in 90 days. There's 1,000 placement agents out there. A lot of people do that. What we do is capital raising workshops, so live intensive worksheets, small group exercises, help you redesign how you're approaching the whole capital raising process. We do pitchdecks.com to do all the materials for someone. No one was helping people with their materials. They had a decade of experience, but the materials look like they just started today. And then on the other side of the equation, we represent families who want to develop their direct investment programs and get better deal flow to commercial real estate, operating businesses, or to help them set up their single family offices. And it's important to note because I think a lot of people get stuck scaling their real estate business or their business in general by saying, I am a conference provider, or I am a real estate broker, or I am this little box. When really I think our success has come from serving the family office industry and arbitraging the inefficiency by providing education and connections, et cetera. And then just seeing what no one else is doing in the marketplace on both sides of the fence. So the more capital raising workshops we do, and we own capitalraising.com, and we have a lot of people downloading that book, the better deal flow we have for the investors. And the more investors we have under contract, like the $125 million family we just closed, then the more credibility we have on teaching people how to raise capital and attract investors. So it might be a little bit confusing, especially if somebody's new to the space, but it's defining ourselves by our niche position and our platform, not by our business model.
Yeah, and I think the thing that's interesting to me is, as much as you are marketing to the family office, it sounds like you've also found the niche on the other side of the table of the people that are trying to market to the family office.
Mm-hmm.
Did I hear that right?
Yeah, that's right. And by doing both, I'm more valuable to both sides. I wouldn't have much deal flow for the family offices if I didn't host events, didn't have people downloading the capital raising book, didn't have the capital raising workshops. My deal flow would be a fourth of what it is.
No, that's incredible. I mean, it seems like you're the keyhole for both sides to make the deal work. That's great.
Well, maybe we try to just be a catalyst. If somebody's already raising $10 million a year. We hope that by going through our programs, they could raise 15 or 25 million a year. We try to, if somebody's already moving through the jungle at 40 miles per hour, we can get them up to 55 or boost their speed. Someone who's going 0 miles per hour, coming to one workshop or anywhere on planet Earth is probably not going to get you to 55, but help things move forward.
Get you rolling there. Got
Yeah.
it. So let's talk a little bit about, I guess first thing I want to ask you is Centimillionaire. I mean, when I first saw the term, I was going like, sounds like a decimal, not the decimal. What's the,
like a Greek name or something?
Either that or the metric. I was thinking like, kind of
like centimeter almost.
Yeah. And I guess, and is that not essentially what it references? Is that what's the point on the millionaire scale for a centa? Is that
it's 100 million plus. So centimillionaire is a word that's been around for several decades. That means $100 million plus net worth. Everyone knows the word billionaire, but I just see a big arbitrage here. Just like 12 years ago when I got into family offices, I saw that almost no one was providing education, almost no one was talking about it, but inevitably in the future, it's going to be a rising tide and people will. The same goes with centimillionaires. Almost no one's ever heard the word before, just like family offices a decade ago, but there are 16 times as many centimillionaires globally than there are billionaires. So everyone's chasing the famous billionaires, the Mark Cubans, et cetera. And they're so famous, they get hit up 1,000 times a day by people with all sorts of crazy requests. They have tons of gatekeepers, lots of resources. And by the way, they didn't just wake up as a billionaire. At some point, they were a centimillionaire first, and they started to gather resources, protect themselves from the world, get those layers in place. So what I'm saying is that if you're looking to raise capital, find a joint venture partner, build a strategic advisory board, get distribution through a titan in your space, forget even trying to meet with the billionaires. Unless you just get introduced to one or one falls in your lap, then of course take the meeting. But I wouldn't even try to put any proactive energy into the billionaires because there's 16 times as many centimillionaires who aren't as busy, don't have as many gatekeepers, and they still need a lot of help. They're still worth, like the client that we're hoping to close today or tomorrow is a $300 million net worth client, and he needs a ton of help, just like someone at $1 billion net worth would, and he could write the $25 million check that someone might be looking for, or the $5 million check, et cetera.
No, I love the fact that you, again, kind of focus in on something that others have looked past or not paid attention to. Because obviously, like you said, millionaire seemed like such a big number when I was growing up. And clearly that's, not that's very common anymore. But
right,
like you said, the billionaire is the new one. And clearly, like you mentioned, the centimillionaire fits right between those and makes sense that there are a lot more of those and more, I guess, approachable, or
right.
just based on the volume. So let me ask you, what are some of the pain points that you've identified that these centimillionaires share that either you and or somebody trying to get in front of those people might be able to provide value or solution for?
Sure. And if any investors are listening, you might have these pain points at 10, 20, 30 million, but I've just found that if you're worth over 100 million, you're going to have most, if not all of these at some point in the near future. One of them is a blurred vision. Many times they have a single focus and then they sell their company. And they might have worked for 20 to 30 years and they sold their company for 50, 200, 400 million dollars. Now they could literally do anything. They might literally live on their new private jet or for 9 months after an exit. Everybody's asking for their time. Everyone wants to JV. Everyone wants them to be the chairman of their company, et cetera. They have offers all over the place. If they're not very clear on what they want to do, they're going to be instructed by other people on what they should do. So you have to have a very clear vision and get clear on how much control you want, what new reality you want to live in, how much transparency you need, what type of returns you expect, what type of income you need, where you want to live and why, what you want for your kids, what governance to have in place, what family office quality solution providers. When we work with a new client on that side, there's usually 50 questions we have to go through so that we can understand what potentially should be their vision, because they're usually not super clear on that and they can't say it in a sentence or two. They don't have it written down anywhere. So the people around you don't even know how to screen meetings for you, because you don't even know how to tell yourself or the person trying to help you exactly what your vision is. So that's a big first one. And a lot of these headaches, they don't cost hardly any money to address and fix. There's a lot of models and processes and thinking tools to move through to kind of mediate the pain of some of these risks and headaches that come up. But we refer to them as centimillionaire migraines, and that's the first one, blurred vision. Second one is family quarrels. A lot of families stop talking to each other. The brother and sister stop talking to each other. And someone might think, oh, that never happened with us. But you might live in different cities. The son might have a natural interest in the business. You might start managing the investment management accounts. And it might turn into a full-time and more job for him that he's not compensated for. The family just expects him to help do this because he's a natural interest in it. He's not paid to do it. And yet if something goes wrong and he loses the sister's inheritance or half of it, then she might be better against him. Or maybe he gets use of the private jet because he's always using it for company use anyways, and he stops over at, the Super Bowl or something, and now the sister hears he's using the private jet of the family to go to the Super Bowl, and she never gets to use a private jet, et cetera. That can all be things where there's just mismanaged expectations and communications, and there's ways to address that. And then the four others I'll go through more quickly, and then you can stop me if any sound interesting enough to talk about more. But deal flow deficiency is a headache. Sometimes they don't even know they have this headache until they connect with other families and find that them considering 3 deals in a quarter is night and day different than someone else who's getting, a deal a day being sent to them, or has a database of 70 companies they would potentially acquire in their industry, and trying to narrow that down to 5 to 10. A sense of loss of control is a headache, because these are usually control freak entrepreneurs who in their DNA, they navigated their own way through the jungle to be ultra wealthy. They didn't get lucky and inherit the money or win the lottery. And then the last 2 are time constriction pains and sensitivity to fees. So many times when people find out you're ultra wealthy, there's a bit of a fiend frenzy, and everybody just wants to charge you 10 times as much just because you're worth more. And that can be a bit painful and difficult for family offices to deal with as well.
The sensitivity to fees it strikes me, and I'm thinking you may be familiar with. I think was there a book, The Millionaire Next Door? It's kind of the one that's coming to mind, where it seems like the study how they had come to the conclusion that most of the millionaires that they were coming across were, Budweiser drinking, Ford driving, and I guess the point was that their perception of this audience before they got into it was these people would be showing up in Rolls Royce and wanted caviar and champagne and that kind of thing. And the reality was they were more of a down home kind of a folk. I'm curious, do you? I mean, obviously, a millionaire compared to a centimillionaire compared to a billionaire, we're talking, big leaps there. Do you find any kind of is there a resistance to the fees, or is there a consciousness of the fees? Or, I mean, I would think that most people that attain wealth, they keep their wealth by not overpaying for certain things.
Right. Yeah, I think there's several things what you just said, and there's some funny stories of. I know one centimillionaire who still lives with his father, and he still lives in the back bedroom, even though he's worth. They have 2 private jets, but they share a house, and that's part of their culture. And he's just cost sensitive because his father gave him a start. I know another one where he met with the family office to help them set it up, and they're worth over 100 million, and they literally requested that we meet in effectively what was a bowling alley. And, that was interesting as well. I think that the core issue on sensitivity to fees is they don't want to pay the Rolls-Royce sticker price for a Honda Civic delivery. So they want it to be performance-based. They want it to be aligned, and they don't mind paying much more than average for much more than average performance. That's what they're looking for. They're just looking for the good ROI, and they want to see it as an investment, not a cost. So they just want people who are eating their own cooking, doing things for the very long term, are very high integrity. Everything about their personal and business life is fully integrated and focused. And the more that they feel like you're playing the same game where you both are keeping score and you both win at the same time, and that they can trust you at every level, then the more they're going to want to lean forward and do business with you. And I believe that so much that the number one core value on the metal signs all around our office is ruthless integrity for our business. And the second value is pantheon thinking, so thinking very long term. But then the third one is speed of implementation. So we're also trying new things to add value to the space, seeing how else we could be serving the families, and finding new ways to provide education in the space. So I think that the process of raising capital is all about getting someone to be high conviction and to trust what you're doing. And I've found the best way to do that is to do things for the very long term and to be very consistent, because it just builds credibility over time.
Agreed. Want to also back up, you mentioned the family quarrels.
Mm-hmm.
Have you seen, or are these family offices, are they run like a corporation where you have board members and I mean, like directors and officers, insurance, and all these things that because it seems like, and I've seen it play out a couple times with wealthy clients, to where as soon as mom or dad dies, all of a sudden the one child thinks the other one's been getting all this unfair advantage all these years, and now they basically end up in court spending whatever large sums of inheritance arguing.
Mm-hmm.
Can you speak a little bit to how these family offices are structured, and then if they do, is directors and officers, is that kind of a thing that they're dealing with?
Yes, some of them do. Usually that comes into play more at a $500, $700 million level or higher. Usually with a $100 million family, not as much. And usually when a family has that level of net worth, they're cash flowing very high, or they've had a big exit. Many times it's an exit to private equity or the public markets, and now they've stepped back as the chairman of the board. So what happens is, a good percentage of the time when the family has a liquidity event until they buy that next asset, they might not be running the large corporation anymore. That's what created the fact that they're ultra wealthy in the first place. But there's a spectrum of how thrifty families are. There's a spectrum of how much governance they have in place and how corporate they feel. And I've just found that the turning points of that 500-700 million and up range, if they're still running the operating business which created their wealth, or have bought a significant new one that creates over 10 million in profits a year, then it's appropriate and very much necessary to have in place that level of kind of corporate governance and risk management and insurance, et cetera.
Got it.
Yeah. And I wanted to point out real quick, just for those that are raising capital, just to see that if you line up, you can be very transparent sometimes with how you market to investors. Because if you really understand, and you're raising capital from dentists that have their own practice, or Porsche drivers in the local business owner Porsche club or something like that, and you really figure out like what are their top pain points, then you can use the same strategy that we have used. We put out this book, Centimillionaire Migraines, which is free at centimillionaires.com, or on Amazon. We sell it as cheap as it allows us to. But the whole point is that while providing value, we're positioning ourselves in front of the investor. And that's the best way I've found to attract investors, is figure out how to add as much genuine value to them as possible, and just be the one who's being most generous in your local or your niche marketplace to that investor type. And you'll attract investors to you instead of chasing them and cold calling them and having them not call you back, et cetera.
Now that attraction marketing is extremely powerful. I think the thing that I found, and I think that I continue to read, is that the lack of vision and understanding of the time frame that one should expect, to actually gain traction or to have that pay results. Do you have any sense that, I know you mentioned how you had built your content and then you were getting these speaking events, and it kind of like snowballed in a hurry, but have you seen that happen with others that you found that are marketing to this audience? Are they having
For
immediate
sure.
success, or is it more of a long-term kind of a?
I think it's a medium
Okay.
term. But if you take a long-term approach and mindset, it actually will go faster because people will smell that and they know that you're really adding genuine value. You're really engaged. You're present during an interview. You're being as generous as possible when you publish a white paper. For me, it was 5 to 7 months of just publishing once every week or 10 days a little blog post or article, and I started getting 100 hits a day on the website over time. I was like, wow, that's amazing. Let me write just 2 or 3 times a week. And I did that. I went up to 500, close to 1,000 hits a day. Started writing once every business day. And then we started getting 5,000 organic hits via Google. And I just looked at the top 500 keywords people were looking for in the niche and then wrote 2 blog posts on every single one of those keywords, and really spiked up the volume on the website. And that got me the speaking invites, the book deals, got me found more often. And I've seen other people who have had just a podcast and then have been able to raise $75 million over time from their podcast audience. I was on someone's podcast last month. They raised $40 million in their first year raising capital, and all the leads came from their podcast. I know someone who does a radio show in San Francisco once a week. They attracted 800 investors, and they've raised over $100 million. And I had a client in the Family Office Club. He's one of our subscribers. He came to our capital raising workshop a year and a half ago, and we told him to write a book on his space and provide value first. He's like, okay, yeah, I'll try to do that. And he's just one of many people who asked that question. And most people are like, oh, I don't have time. That's too hard. I'm not a writer. They have every excuse not to do what I think works. And then at the next workshop in Atlanta, I saw him. He said, hey, I just wrote the book last month and I already raised $600,000 from that. And then he was in Toronto on Thursday last week. And I got to start inviting this guy to all my workshops because he stands up in front of everyone and is like, hey, follow this guy's advice because I did it. And now I've raised over $10 million and I'm working with a billionaire, all because I wrote a book on my niche and I didn't even think it would work. But I just did what he said and it worked. So I love this guy, but he's just a genuine example of something that just came up on Thursday in Toronto of it does work. But the 3 to 5, 5 to 7 months, just a long-term mindset. And the trick I've found over and over again, when people resist doing this and they resist putting a lot of effort into building an educational thought leadership funnel, it's because they don't believe in their niche enough. If you find a sandbox you want to dominate over 5, 10, 20 years, and the niche is so valuable that if your name was associated with that keyword term or that niche, that over time, it would just explode the amount of opportunities you have in front of you, then you should be willing to do any amount of hard work to dominate that sandbox. And if you don't believe that, then don't even start writing the content. Like just meditate and figure out what it is first.
No, that's really powerful. There's again, if you don't believe in it, I mean, remember the Zig Ziglar there. If you're driving a Ford and you're selling Chevys or whatever that was,
Right.
Rethink that there. So that's good. Richard, I want to reemphasize your book. The title of the book is it Centimillionaire Migraines? Is that right?
Yeah, Centimillionaire Migraines, the top 6 headaches that my $100 million families have, and solutions and remedies for those.
All right. I want to shift gears here, if we could, just for a second. As I mentioned to you before we started recording, I'm an insurance broker by day. And risk management is one of the tools we use to determine what the path is or how to manage a risk that one of our clients has. And there's essentially 3 strategies that we employ. One is avoid the risk. Second one is minimize the risk. And then the third is transfer the risk, which is essentially what an insurance policy is. And I've been asking my guest here as of late if they could identify what they see as the biggest risk, whether it be their clients or real estate investors face today. And I'm not necessarily looking for an insurance-related answer,
Sure.
but I'd like to get your opinion or your viewpoint of what you see as the biggest risk.
Yeah, I mean, I think it's key man risk. I mean, there's other non-insurance ways to say it, but the fact is a lot of people who created wealth for their family, a lot of their strategies are in their head. Or even for myself, my work with the families is done with me directly. I've got an 18-person team that helps me put on our 25 live events for our Family Office Club charter members, subscribers each year. But, if I didn't show up to those events, after how many events would it start to slide or go downhill? and I'm the one who teaches all of our capital raising workshops, so I'd have to stop offering those. So I think it's tied not only to the risk of what's slowing down our growth, is oftentimes the CEO not delegating and getting out of their own way, but above that really is documenting standard operating procedures, figuring out what would happen if the company needed to operate without you. Because the truth is, most of us as business owners or real estate sponsors or developers are doing more than we want to do or like to do or know we should be doing. But we like to hold on to things, make sure it's done right, because we respect our clients. We want to make sure at the end of the day, the bottom line is healthy. And but all of us could probably do a better job systematizing, creating checklists, pushing things down, and making sure that you're not too much of a key man when you don't need to be. There's probably only one or two things you should be doing with your time, and most of us are doing too much. I think it's just a constant process of just getting out of the things which are not kind of your unique ability, as Dan Sullivan would say.
I want to ask you just on that. Can you tie that to one particular thing? I mean, is it a fear of it won't get done properly, or is it a fear of it won't be done the way that you've done it, or is there?
Yeah, I think it's a fear that it won't get done in a way that's agile enough to adjust to the dynamic relation of what's going on. So if I trust someone to go to a meeting with a family office and I'm not there, I could give them a script and tell them what to say if then. But a lot of it draws upon a lot of random experiences they don't have in their brain. Or if something starts to go wrong at an event and you need to nicely tell someone who's been speaking for 17 minutes and they had a 10-minute timing slot and politely tell them to, like, get the heck off the stage, please. You're making us late for the event. How do you do that in a polite way? Or if somebody says something rude on a discussion panel and you're the chairman, you're the head of that discussion panel and the moderator, how do you smooth that over and joke a little bit about it, or get past it so that the audience doesn't think you agree with this rude person on stage? Or, there's little nuanced things that part of it is realizing that, yeah, it might only be 80% as good, but you have to choose your battles. And with some things that might be okay that it's at the 80% level, and you choose the one or two things that have to be pristine, or find amazing people, I guess. I'm not an expert on that, or I'd have 1,800 employees and not 18.
Right. No, I'm glad you shared that with me, because I think that's one of the things I've found just to be so true with small business is that most successful small business owners are successful because they're good at running or they're the best salesperson or whatever it might be. But
right.
The management and delegating is not necessarily one of their strong suits, and it's like a luxury. The management, they don't want to pay for management, or there's a resistance there, and it's basically, hey, it worked for me, it worked for you, just do this.
Right.
But no, that's definitely a universal struggle there, and I appreciate you sharing that with us.
Sure.
Richard, before we wrap up, I want to ask you, where can the listeners go if they'd like to connect or learn more?
Cool. There's actually 3 quick places. Just take 30 seconds. The first is familyoffices.com, where you can learn about charter membership, our 25 live events. The schedule of events is on the website. We also have a free book on family offices for free there. If you're raising capital, we have capitalraising.com, a free book on raising capital. And if you get an email then as a reply, make sure and request our free webinar we did a couple weeks ago on capital raising. It's an hour long and really good. And then the third place is just Centimillionaires.com. If you want to grab this book for free, or you're an investor and you want to figure out how to mitigate some headaches coming your way, you can get that at Centimillionaires.com. All
right. Well, Richard, I can't say thanks enough for taking the time. I've enjoyed talking with you. I've learned a lot, and I hope we can do it again soon. All right. And for our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.